Life insurance, like anything else, has its advantages and disadvantages. In this video, you're going to learn 3 quick tips to avoiding the disadvantages while maximizing the advantages of life insurance. And be sure to stay around till the end for a valuable resource that will help you learn how you can get your life insurance essentially for free. If you want to maximize how you use your money so you can pay off all of your debt and build tax-free wealth with the same dollars at the same time, then subscribe to our channel and ring the bell. That way you'll be notified when new videos get published. When it comes to buying life insurance, I'm here to tell you that just about everybody is doing it wrong. Here's what I mean. If your life insurance isn't essentially free, then you need to keep watching. Hi, I'm best-selling personal finance author Tony Manganello. And since 1995, my business partner John Commuta and I have taught over 3 million people how to accumulate real wealth while helping them understand how money really works. And over the next few minutes, you're going to learn 3 tips that will help you discover if the money you're spending on life insurance is working for you or against you. The first tip to maximizing the advantages and minimizing the disadvantages of life insurance is probably going to shock you because, well, it goes against what most popular financial gurus teach. Are you ready? Do not, I repeat, do not buy term life insurance. Oh, but Tony, term life insurance is cheap and you get more life insurance for your money when you buy term. You know you've heard that phrase, you get what you pay for. Well, that's exactly what you get when you buy term life insurance. Have you ever asked yourself why term life insurance is so cheap? The reason term insurance is so cheap is because it almost never pays out. You know, you've seen those commercials where you hear about Bill is 35 and he can get a $500,000 20-year term policy for just $27 a month. Now let's do some math because when it comes to how money works, it's all about the math. If Bill pays $27 a month for 20 years, that's $6,480 in total Bill will pay for that $500,000 in coverage. Now, we both know that insurance companies are not in the business to lose money, right? So how many bills have to be insured so the insurance company won't lose money? Now, to answer that question, you need to divide the amount the insurance company is on the hook for. That's the $500,000. You divide that by the total amount all the guys like Bill will pay for their policies, the $6,480. The answer to that question is 77.2. This means that Bill has a 1 in 77 chance his policy will pay out. That's just 1.3%. Now, am I oversimplifying this equation? Of course I am. Life insurance companies, they have people called actuarial scientists that study statistics and mortality tables and a lot of other numbers to make sure the insurance company won't lose money. And what that means is that you probably have an even smaller chance your insurance policy will pay out, which, by the way, means you're probably going to live longer than your life insurance policy has you covered for. And guys like Bill will get nothing in return for their $6,480. Oh, but Tony, think about the peace of mind Bill has while he's insured. That peace of mind gets flushed right down the toilet when Bill discovers when he hits 55, he's got no life insurance. And now to get the same $500,000 coverage will cost $500 to $600 a month for a new term policy, and that's if he's in good health. Term insurance is cheap because they cash 100% of your checks, and there's a 98+% chance you won't get any benefit at all. Term insurance was made popular in the late 70s by a guy named A.L. Williams with his motto, buy term and invest the rest. The problem with that strategy is that a ton of people, they didn't invest the rest. They spent it. And they got to the end of their term with no savings and no insurance. How's that for peace of mind? Have you ever thought about your insurance coverage this way before? Let me know in the comments. The second tip to maximizing the advantages and minimizing the disadvantages of life insurance, it's a bit like the first tip. This tip is to never, I repeat, never buy an off-the-shelf whole life cash value life insurance policy. Off-the-shelf whole life insurance policies, well, they're typically pretty poor performers. And this is what helped make the A.L. Williams motto, buy term and invest the rest, so popular. The problem is that most people didn't invest the rest. They spent it, like I said. And for those who did invest the rest, market conditions threatened the safety of their savings. Remember 2008? And future tax liabilities would reduce any benefit those savings had for their retirement. But the plans on the surface seemed better than the off-the-shelf whole life policies, so people bought them. All right, I hear what you're thinking. But if you shouldn't buy term or whole life insurance, what the heck should you buy? Well, the answer to that question is what tip number 3 is all about. Tip number 3 to maximizing the advantages and minimizing the disadvantages of life insurance is to buy only the amount of insurance the IRS requires. I know, what the heck does the IRS have to do with life insurance, right? Well, for a long time, rich people would ask their financial advisors for help sheltering large amounts of money. Their advisor would say, hey, we'll shelter it in a life insurance policy. The rich guy would be like, life insurance? What the heck do I need life insurance for? I'm rich. The advisor would say, don't worry about it. We'll only buy a real small amount of life insurance and then stuff all that extra money in the cash value of the policy. Now, it wasn't long before the IRS discovered rich folks were sheltering large amounts of cash in insurance contracts. And we both know how the IRS likes to get their hands into our pockets, especially rich people's pockets. And for the IRS, though, this was quite the dilemma. They wanted to get their hands on that money, but at the same time, they knew life insurance is considered widows and orphans money. So they came up with something called the IRS 7 Payroll. What this rule did was place requirements on how much life insurance a policy would have to have in order for the cash value to grow inside a tax-sheltered life insurance contract. And this is what tip number 3 is all about. When you place only the amount required by the IRS on your life insurance contract, your cash value grows real fast, and it grows tax-free. And when your cash value grows this fast, eventually the growth inside the policy exceeds the amount you're paying for the policy. And when that happens, your life insurance is essentially free, and you now have a tax-free savings plan. Now, these types of plans are incredible when it comes to saving for your future, paying for junior's college, taking vacations, buying cars, and living the life that you deserve. And when you're ready to quit working, these types of policies pay for themselves. So you'll have the life insurance you need without having to pay for it and a stockpile of tax-free cash when you're ready to quit working and enjoy your golden years. Knowing how to structure a life insurance policy like this, well, it does require some additional info. And that is exactly what the resource I mentioned in the beginning of this video is all about. It's an ebook called The Banker's Secret to Permanent Family Wealth, written by my business partner, John Commuta. And you can get your hands on a copy of it by clicking the link below. If you like this video, do me a favor and click the like button and let me know. And while you're at it, subscribe to our channel so you can continue to discover more advantages to making money work as hard as possible for you. Did you ever think you could get life insurance essentially for free? Let me know in the comments. You know that life insurance is a necessity if you're a responsible adult, and there are 2 ways you can pay for it. You can either throw your hard-earned cash away like most people do, or you can use life insurance to tax shelter a robust savings plan and structure your policy so that the death benefit will essentially become free. The cash value will grow real fast, and you can take advantage of the tax benefits life insurance contracts offer so you can accumulate some real wealth. The choice is yours, and I don't think you want to throw your money away. Thanks for watching, and I'll see you next time.